Hey everyone, welcome to the second video in our multiple choice questions, how to approach it, how to answer it, so forth. So let's jump right into it. So we're doing module 2, and question 1 that we're going to go through is passive income is most likely to be which of the following types of income. So just to do a quick recap from our tax notes, tax videos, if you haven't watched the core content videos for this module, we recommend you do that just so you got the good basis for doing it. But if you are too close to your exam and you just want to learn, you've only got 2 weeks left, then I just recommend just going through the practice questions only, because you should be spending your time doing that. But just to quickly recap what passive income is, that's income that you generally generate when you're not, incurring the income yourself. So for example, if you've got interest because it's got cash in the bank, or you've got an investment property and sharing rent, or you've got shares and sharing dividends, or you've got some sort of IP and you're sharing royalties. So this is passive income, and this forms part of ordinary income. Right, so this would not include statutory income, which is a different category, and that's statutory income is basically things that are specifically defined in the Act. So it includes, so it's all listed out in this specific section. So it includes things like capital gains, could include statutory non-cash rules, like so non-cash business benefit, could be Division 15, so it's allowances, return to work, royalties, profit making. And capital gains is probably the main one, which is listed in this section 10-5. So the answer to this one is clearly going to be ordinary income. And the reason is passive income, rent, interest, etc., they're going to fall under ordinary income. Capital gains would probably fall under this one, same with non-cash benefits. Exempt income is things which are specifically, exempt from trading. It's only from taxation, I should say. So it's only very specific things. For example, fringe benefits, non-portfolio return on equity, that's in the international tax section, which isn't in the CPA module, or certain income received related to army reserves, work, etc. So they're quite specific things, not going to be that one. NANE is very similar to exempt income in that it's not assessable, except the only difference between NANE and exempt is that NANE does not reduce tax losses when you use it, whereas if you have any tax losses and you have exempt income, it's going to use up the same amount of tax losses. So again, it's only those specific things. So it's either going to be ordinary or statutory. In this case, it's clearly going to be ordinary. So B is the correct answer for this one. All right, so for the next question, let's go through that now. So the next question is, in preparing the tax return for an Australian resident individual, which one of the following is exempt income? So now this is going to be talking about exempt income and also partially around residency as well. So I've got a different video for around residency as well. So let's go through the answers quickly, possible answers. So the first one is A, an outdoor table and chairs setting worth $250 that is received by a retailer from the manufacturer of the outdoor setting and is given by the retailer to his son for use at the son's home. B, a scholarship received by a university student from an employer for whom the student works during vacation. C, salary received by a student course advisor employed at a public education institution. Or D, a dividend received from a company resident in the United Kingdom on which withholding tax has been paid in the United Kingdom. Okay, so let's go through this one. Now, how I would approach this is, because we're trying to figure out which one is exempt income, let's instead of going through these one by one, let's look at what constitutes exempt income and then look for that within the answers. So if we bring up our notes, which you can purchase from our website, exempt income is down here on page 10, and we can see that these are the key exempt income components, and they're specifically listed as I mentioned before. So the first one is any amount of ordinary which is deemed exempt. That's not very helpful. What else? Okay, so it includes all of these. So any registered charitable bodies, religious institutions, scientific institutions, public education institutions, employee and employer associations, trade unions, public hospitals, animal racing. So any of these organizations that receive income, if they're a certain entity, this will be exempt income for that specific entity. So it wouldn't be for the employees of that entity, it would just be for the entity itself. For example, donations to a religious institution, they would record that as revenue, but it'll be exempt income because it's a religious or charitable body. The next type is specific types of ordinary and statutory income. For example, pool development fund dividends, non-cash business benefits that do not exceed $300, family tax benefits, allowances received by family members of the Defence Force, or scholarships paid to full-time students. So basically what I would recommend doing is looking for just one of these in it. And just as a quick cap for non-cash business benefits, that's actually, so generally speaking, non-cash business benefits is statutory income. And a non-cash business benefit is like if you receive a gift or something like that, which if it was convertible to cash, you'd treat it as statutory income. Like if they give you, $1,000 worth of, let's say $10,000 worth of, wine, for example. If that was, paid in cash, that would be income. Therefore, that would be statutory income, unless it's an exception. These are the exceptions down here. One of the exceptions is if it's less than $300, then the income is exempt. Anyway, so that was just a bit of background. I was getting a bit off track. So all we want to do is basically look for one of those categories. So pooled development funds, non-cash, less than 300, family tax benefits, allowances received by members of the Defence Force, or scholarships paid to full-time students. Okay, so let's go through these and just see if it fits in with that list. So the first one is an outdoor table and chairs that is received by a retailer from the manufacturer out of the outdoor setting and given by the retailer to his son for use at the son's home. So this would be a non-cash benefit, right? Because the store or the retailer is giving his son the chairs worth $250, and that if they were paid in cash, that would be assessable income. However, it's less than $300, and it's a non-cash benefit, so that would be exempt income, right? So the answer we know is A already, but let's just check through B to D, just in case we've missed something. All right, standard practice. So B, a scholarship received by a university student from an employer for whom the student works during the vacation. Now, while a scholarship is paid to full-time employees, would be exempt income. You can see here that it's not a full-time employee because this person works during the vacation. Okay, so B is incorrect for that reason. C is a salary received by a student course advisor employed at a public education institution. And again, don't be confused, because I know in the notes we went through and we said, a education institution is one of the entities which income of that entity will be exempt. But remember, it's the income of that entity, not for the employee. For the employee, their income is the wage, right? But it's only the entity itself, so the institution. So donations to the institution, government funding to the institution, that would be exempt income. But any salaries paid to students, that's completely different. That's the student's course advisor's income, right? Which would be assessable income because it's wages, right? And then D, finally, a dividend received from a company resident in the United Kingdom on which withholding tax has been paid in the United Kingdom. Now, dividend income is obviously assessable income. We know that from the notes. So the only question is it actually assessable in Australia? And that's when we start to get into our notes from the residency chapter or section within the tax course, right? So it comes down to where is that assessable? So it's a resident in the UK, so it's not even an Australian resident. Remember, Australian residents are assessed on the worldwide income, whereas if you're a global, if you're a foreign resident, like let's say you're a UK resident, you're assessed in Australia on your Australian income in Australia, but we know that it's a foreign resident being assessed on income incurred in the UK, so therefore there's nothing to do with Australia, therefore it's not assessable in Australia. It might be accessible in the UK, but not in Australia. So it's not B, it's not C, it's not D, but A is correct, so the answer is A. Alright, so for the next question, at 30 June 2018, Daniel has adopted the market selling value for 2,000 widgets, being the trading stock at hand at that time of $180. Okay, so this is to do with trading stock, right? So he's got COGS, his closing balance of inventory, 2,000 times $180. So in order to legally minimize Daniel's assessable income for the year ended 30 June 2019, what valuation should be adopted as the taxation value for trading stock at 30 June 2019? Okay, so basically what this is talking about, which we discussed and explained in our core content video on trading stock, is basically you have the option of, with trading stock, you have the option of what valuation method you want to have your stock at the end of the year, right? It doesn't need to be the same. You can actually switch it year on year. But so the question is basically asking, what would minimize his assessable income? To do that, which method should we have to choose? And they've told us the different values. If it was at market value, it's going to be $250. If it was at replacement value, it would be $200. So to figure out what the answer is, we need to understand what the formula is in terms of calculating assessable income, right? So basically, if your closing stock is greater than your opening stock, you're going to record that difference as assessable income. So if we're going to minimize his assessable income, what we want to do is we want to minimize the value of closing stock. So basically we need to figure out which value of these has the lowest value of closing stock, then choose that method, and that's going to effectively reduce his taxable income. So in this case we've got 250, 205, and this one's 200, so clearly this is the lowest value. But hold on, let's just check out C, because it doesn't seem to have a value in there. Well, it says here, it must be the same value as the opening stock on 1 July. Well, that's incorrect, right? Because how it works is, currently it's under the market selling method, right? So the choices we have is cost, market selling value, or replacing value, or reasonable value, right? So you basically choose one of these options, right? So currently it's market value. So if it's going to keep the same value, then the market value, which is $250, would result in assessable income of $70 per unit times 2,000. Whereas, he can choose that option, which is basically the same as this one, which is incorrect. Or he can choose replacement value, which will result in a $205 or $25 times 2,000 in his assessable income. Or this one will be $20 per unit times 2,000 in his assessable income. Either way, this one is going to result in the lowest assessable income. Therefore, D is the correct answer. Alright, so next question is about forex realization. So to answer this question, it's going to relate to the section on forex that we talked about. So in our quick reference notes, we've got that just above trading stock up here. So this is regulated, so anything to do with foreign exchange, provided TOFA rules don't apply, comes under Division 775. And there's basically 5 main FRE events. There's FRE 1 through to 5. So all we have to do for this question is understand basically what each of these mean, and then apply the most relevant one, right? So in this case, we want to know which forex realization event occurs when a taxpayer ceases to have a right to receive foreign currency. So ceases to have a right to receive foreign currency. So let's see where we can find this one. Ceases to have a right to receive foreign currency. So clearly the answer is FRE 2. So the answer is B for that one. Fairly straightforward. Alright, so next question is, which of the following is an indicator of ordinary income? A, receipts which are expected. B, receipts which are a return of investment. C, receipts which are not in a money convertible form. Or D, receipts which are not deductible. So all we have to do for this particular question is go back to that original table in our notes with all the different, that page where it says assessable, statutory, and exempt income, and it's got some definitions of what is included in each of them. So the definition for ordinary income is periodic, regular, expected, relied upon. I mean, this isn't necessarily the definition, but these are indicators that it probably is ordinary income. For example, expected, you're expected to receive your wage each week, but an unexpected windfall, for example, perhaps selling your shares because there's a one-off event, it's not likely to occur multiple times because the stock price increased and you didn't know. Regular, it's not regular, it's a one-off occurrence. If it's a capital gain, you're going to sell it once and that's it. Periodic, you receive your wage every 2 weeks or a month, depending on the company. Whereas capital gains, again, you only sell it once off, it's not recurring. So if we go back to our question, I mean, all of these are in a sense correct, but with CPA questions, we're trying to find which is the most correct out of all of them. So let's go through it. Receipts which are expected. Can we see this on our list over here? Yes, expected is on the list, so most likely that's the correct answer. B, receipts which are a return of investment. I mean, that's not necessarily in our list of these. I mean, it could be a statutory income, like a capital gain is going to be a return of investment, or it could be talking about passive income like interest or dividends, etc. But either way, those words are not specifically in our indicators in our notes, so it's correct, but not the most correct answer. And then C is which are not in a money convertible form. Again, that's not specifically listed in our indicators, so we're probably not correct. And then finally, receipts which are not deductible. Again, it's not really on our keywords of indicators of being regular, expected, periodic, and relied upon. So clearly A is the most correct answer out of all of these, and therefore the correct answer to this question. Alright, so next question is, which of the following is most likely to be considered ordinary income? A, wages received from part-time employment. B, proceeds from the sale of a share portfolio. C, an inheritance received from a deceased relative. D, capital gains. Okay, so you should know by now, what are the key indicators of ordinary income. We went through that in the last question. So, and it includes things like wages, income from carrying on a business, passive income, whereas statutory income is things like capital gains, windfalls, non-cash business benefits. So if we go through this list, this is wages, that's ordinary income, so clearly that's the correct answer, but let's just go through the rest just in case. Proceeds from a sale of a share portfolio, that would be statutory. Inheritance from a deceased relative, that would be statutory or exempt. And capital gains, that would be statutory. So clearly the answer is A for this question. Alright, next question is, what action is required if a taxpayer purchases trading stock in a foreign currency and the currency spot rate is higher on the day the cash payment is made compared to the date of the invoice? Okay, so A is there is a forex realization gain which is added to assessable income. B, there is a forex realization loss which is added to allowable deductions. No action as the currency spot rate when payment is made is used to value the purchase. Or D, exempt income, no realization event occurs. So to answer this question, what we're going to do is we're going to bring up our notes. I'm going to go to the section on foreign exchange. So let's just bring that up now. Okay, so just to quickly recap the foreign exchange rules, which is Division 775, basically is if there's any realized, like actual payment, like paper gains doesn't count, right? It must mean they've actually paid money. Let's say you've got an accounts payable, an invoice, for example, on the 3rd of July in US dollars. You then record that payable amount on that date, right, based on the current exchange rate. Then in a month's time or 60 days, 2 months' time, once you actually have to pay the bill, the exchange rate might have changed because it's in US dollars, right? And that means because you're actually paying that money, there's actual payment. You then again to in order to debit or credit that journal, you're then going to have a difference, right? And that difference is going to be assessable income or deduction, and that's going to be your foreign currency exchange gain or loss. Now, depending on whether it's a FRE or foreign exchange realization event, will depend on in terms of which account it actually applies to. So first of all, generally the process is we need to identify which FRE it actually applies to. So some people have trouble understanding what each of these are. So ceasing to have an obligation to pay foreign currency is basically when you, for example, in this situation, we've got an invoice to pay for stock, right? We've got that invoice in advance, we've got that payable. We have an obligation at that point to pay it, right? Then later on, once we actually have to pay it, let's say in 60 days trading terms, we then pay it. That's when the obligation then ceases. So that in that case, a lot of the time when we're paying an invoice for an overseas supplier, then FRE4 event is going to apply. So if we look at the situation here, we've got a taxpayer purchasing trading stock. So anything to do with purchasing is often FRE4. And we can see same situation. The currency spot rate is higher on the day the cash payment is made relative to the date of the invoice. So they've been given a date of the invoice, they've recorded a payable, then 60 days later they pay it. So clearly this is a FRE4. So in this case, the situation would be we have to figure out whether they've got a gain or a loss. So we can see that the currency spot rate is higher on the day the cash payment is made compared to the date of the invoice. So this isn't super clear in terms of what this is actually saying. The currency spot rate is higher. So let's say the local currency, let's just clarify this, AUD spot rate is higher on the day. So if the local currency is appreciated, the AUD, that means that on the date of payment compared to the original invoice, the company, the taxpayer, will actually pay less for the purchase than they thought initially when they received the invoice, because the foreign currency is worth less because the Australian dollar is worth more. So let's just put these in brackets. So in that case, because they're paying less than they originally thought, that's going to result in a gain. Remember, anything that is in the favor of the taxpayer or the purchaser is going to be income or assessable income. Whereas if they lose money because they've got to pay more, there's going to be a deduction. Which makes sense, right? Because if you're purchasing something that's trading stock purchase, that will be a deduction. And if the value of that purchase increases, then that would also increase the value of the deduction. So in this case, the answer is A, assessable income. Alright, so which of the following is not included in the calculation of assessable income? A, exempt income, B, ordinary income, C, statutory income, or D, capital gains. So to answer this question, we have to go to the initial page from Module 2 in terms of what's actually comprised of assessable income. So here it is here, it's this diagram here. So your taxable income is equal to your assessable income minus deductions. And your assessable income per Income Tax Act 1997, Section 6-1, includes your ordinary income and your statutory income, but it excludes exempt income and non-assessable. That's 9A. So basically, ordinary income we covered, yes, that's included. Statutory income, yes, that's included. Exempt income is not included. So the answer, change this to 9A income. So the answer to this one is clearly, capital gains should be included as well. Let's just delete that one. So clearly the answer is A, exempt income, because it is the only income that is included down here in the exempt income section. Alright, next question. Which of the following statements about assessable income is most correct? A payment received by an employee from an employer to compensate them for the loss of sale in their private home will be income. B, an old age pension paid to a pensioner by the government is not ordinary income. C, payments to a volunteer respite carer to cover the expenses of providing care to persons with disabilities is not income. And D, the proceeds from selling illegal drugs are unlikely to become assessable income. Okay, so let's go through each of these and figure out why they are or aren't assessable income. So the first one is a payment received by an employee from an employer to compensate them for the loss on sale of their private home. So anytime you see the word compensate or compensation, we need to think, okay, that's compensation, right? So compensation is, in its own right, a special topic. So let's bring up our notes where we talk about this. So compensation is basically when you receive money to replace and take the character of the item that it is replacing. So for example, in this particular example, we're saying it's the employer is giving money to compensate them for the loss of money on their private home. So that loss of money on their private home should have been consideration, or an increased or an amended cost base, right? So compensation in this case is most likely going to be capital, right? So capital in this case, is going to be capital income, may or may not be assessable. It might just form part of the cost base of the property in this case. So, whilst it's possible, most likely it's going to be capital and therefore not necessarily income. So let's come back to this one because it may not be the most correct one. All right, next is, so it's not going to be income, it's going to be capital, basically. That doesn't prevent it from being assessable income. It might, because capital can be assessable income as a capital gain, which would be statutory income, but in this case, all it's saying is income, which is probably not correct. Okay, so for the next one is B, old age pension paid to a pensioner by the government is not ordinary income. So let's just quickly recap on the definition of ordinary income. So it's basically any payment which is periodic, regular, expected, or relied upon, and isn't any of these specific exempt items. So a payment from the government, like a pension, is periodic, yes. So it's regularly received, it's regular, it's expected, and it's relied upon, right? So it satisfies all of those indicators, and it's usually connected with a source, which is the government. And then finally, it's not any of these excluded items. So it's not gifts of love or affection, it's not windfall gains, it's not non-cash benefit. So in this case, it satisfies all the requirements to be ordinary income. So in that case, this most likely would be ordinary income. Alright, next one is C, payments to a volunteer, respite carer to cover the expenses of providing care to persons with disabilities are not income. So for this one, okay, this is one you just have to remember because it's one of those things that's just very specific and relates to a specific ruling. So if we go to our notes, I've just added in a comment here. So tax ruling 2004/75, which is basically when the ATO or other organization, where there's an area where it's a bit of ambiguity, they'll put out a specific ruling where people can refer to this and say, okay, that's the interpretation. We can apply that interpretation. So in this case, they've got this very specific example where payments to a volunteer, respite carer, to cover expenses of providing respite care for a disabled person are not assessable income. Okay, so the answer for this one is that is correct as well. But let's just check this D. The proceeds from selling illegal drugs are unlikely to be assessable income. So basically the rules with illegal income is that it actually is assessable. Just because it's illegal doesn't make it not assessable, right? So if they catch you with selling drugs, right, you still have to pay tax on that assessable income, regardless of illegal, but the catch is you can't actually claim any deductions against it. Alright, so next question. So the answer is C for this one. So the next question is, which section of the income tax legislation provides a list of provisions that are considered to be statutory income? So to answer this one, all you have to do is go to our notes and go to right here, statutory income. So section Income Tax Act 1997. It's not on the screen. Section 10-5 provides an alphabetical list of statutory income. So the answer for this one is fairly straightforward. It's just C, this one over here. Alright, next question is, Con is a sole trader who operates a local furniture shop through which he sells goods that he purchases from wholesalers. The following transactions were recorded for the current year. Number 1, Con took a sofa for his own use in the family home. That cost $500 and had a market selling value of $900. Con gifted a table lamp from his stock to his daughter that cost $100 and had a market value of $250. How much is included in Con's assessable income? So let's just recap the facts of this. So he's a sole trader, so that basically means he hasn't set up a different company, but he's still operating a business, but it's just by himself as the entity. So he'll include income from his little retail shop, furniture retail shop, in his personal tax return, but it also means because he's operating a business, he still is going to have trading stock, he's still going to have, business expenses and things like that. So the following transactions were recorded for the current year. Number 1, Con took a sofa for his own use in the family home that cost $500, market value of $900, and then number 2, gifted a lamp to his daughter, blah, 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 blah. So to do this, all we need to do is open up our notes and go to the section on trading stock, right? Because that's what we're dealing with. He's operating a furniture shop, and a couch or a sofa or a lamp, they're all trading stock because they're things that he's selling in the ordinary course of his business, right? So Division 70 is the key act. So what we want to know is disposal of trading stock, and that includes in the ordinary course of business, so like when you make a normal sale, not in the ordinary course of business. That's when you still dispose of the goods, but it's not how you normally do it. And then there's other ones, so there's notional disposal. So that's basically normally when you change legal entities, like he set up, like a different entity and he's disposed of it, or it's deemed to be disposed of it because he's transferred into a company, for example. Then there's a situation where he ceased to hold item as trading stock, but he still owns it. So in that situation where he's as a sole trader, it's trading stock, but then he personally owns it. So it's still the same person who owns it, but it's no longer held as trading stock, right? And then the last one is trading stock lost or destroyed. So the first situation that we're going to look at is took a sofa that cost $500 for his own use in the family home. So he's basically transitioning it from himself as trading stock to himself as non-trading stock. So in that case, the situation that we would want to refer to is probably this one here. Cease to hold item as trading stock, but still own it. So in that case, we can see the keyword highlighted here is cost, right? So we basically dispose of it for cost. And that's per section 70-110. So for part 1, Con is going to have to include $500, which is the cost value, in his tax return as a sole trader. Now the second part is Con gifted a table lamp from stock to his daughter that cost $100 and had a market value of $250. So let's have a look and figure out which of these particular situations is applying here. It's not this one because he's not transferring it to himself, right? He doesn't still own it, so this one's not applicable. It's not in the ordinary course of trading because it's not a normal arm's length transaction. So what it is actually this one, not in the ordinary course of trading. And that's basically when you dispose of something, but it's not a normal sale, right? So that's what's happening here. He's disposing of it personally. It's being transferred to his daughter, and that's not in the ordinary course of business. So in this case, how we have to treat it is it's assessable on the market value of the stock on the date of disposal. So the market value of the stock per the question is $250. Okay, so the answer is we need to sum the $500 cost plus the $250 market value equals to $750. So the correct answer for this one is B, $750. Okay, next question is, which section of the Income Tax Act 1997 prevents income from being taxed as both ordinary and statutory income? So let's have a look at our notes and see if we can find this. Where is our notes? Okay, cool. So let's scroll through here and go back to ordinary income, and hopefully we can just find it in here. So I guess the logical thing is we know it's not going to be C, section 8-1, because we know that section 8 relates to deductions, whereas section 6 relates to income. So it's either got to be A or B. So let's bring up our notes again. And if we go to this section up here, we can see ordinary income, section 6-5, statutory income, section 6-10. However, the act that says no double counting, no overlap is section 6-25. So the answer for this one is B. Okay, so next question is, which section of the Income Tax Act lists the categories of entities that are exempt from income tax? So let's bring up our notes again. So we want to know the entities that are exempt, and if you remember, we cover that over here, which is section 11-5, so the answer is B, right there. Next question is, John has $4,000 of statutory income, $10,000 of ordinary income, $3,000 of exempt income, $2,000 of non-assessable, non-exempt income. What is John's assessable income? We are missing the multiple choice for this one, so we're going to delete this one. Apologies for that inconvenience. Okay, so, alright, next question is, which section of the Income Tax Act 1997 explains what non-assessable, non-exempt income is? So all we have to do for this question is open up our tax notes and go to the section on non-assessable, non-exempt income, which is down here. We can see section 6-23, so the answer is C. Pretty easy. Alright, next question. GST collected on taxable supplies is considered which type of income for income tax purposes? Okay, so if we bring up our notes for this one, we can see non-accessible, non-exempt down here. We can see GST payable on taxable supply. So the answer for this one is C. Okay, so we're roughly 30 minutes in. We've still got a lot more questions that you can practice on your own, but I think that's given you a good basis to kind of understand how to approach these questions. We're generally aiming for 30 minutes per video in each of these, and then anything after that we recommend to kind of practice in your own time. Just do as many as you possibly can before your exam, and you should ace it. So I think that covers us for topic 2. You can practice the multiple choice quiz application down the bottom of this page. Otherwise, I'll see you in the next video where we'll go through module 3.